Disney is now the #1 streaming company out there. Now, it's not all Disney Plus, but Disney Plus, Hulu, as well as ESPN Plus are now combined the largest streaming service out there. This is what I love about Disney. Disney's now dominating on Hulu. I have Hulu, but more importantly, ESPN. Guys, TV is changing, absolutely changing. The one area where you can rely on ad costs is where? Live sports. They have ESPN, ABC, they have all these things that can get live sports. That's where the big money is going to be generated in advertising for the future. Why? Because now, if you're like me, you go watch a show. I'm in London right now. My fiance and I were watching TV last night. I remember thinking to myself, good Lord, there's a lot of commercials because we couldn't stream anything because our streaming wasn't available because we were in London and the whole setup for where you're at, etc. But we were watching TV. Did you not notice that, Lisa? I was like sitting there going like, what is this, a commercial every 2 minutes? It was literally over and over. So when I watch sports though, guess what? I never care because I'm watching a live game. I'm okay with that. So we're going to analyze Disney. We're going to put it in our 8 pillars. I'm going to go through it thoroughly and then look at our analyst estimates as well as then our stock analyzer tool to tell us what price to pay for Disney today. So on our software, I'm typing in Disney. I think I remember how to spell it. There we go. Walt Disney Company. I'm a good boy. So first things first on Disney, 52-week high, $180 per share. It is currently at $100. Guys, this is a company, I think $100 where it was selling for pretty close to COVID here. This is the COVID low right here of like $80, $85 a share. We're getting close to the COVID levels. Guys, Disney shut down after COVID. The parks were 40% of their revenue and they went to 0 during COVID. And the stock is currently selling for almost that level. Does that mean you should buy it? Pump the brakes. Not necessarily. One of the biggest mistakes that investors make is they just look at stock price relative to history and say, wait, I should buy it because it's a good indicator to start doing more research. This attracts my attention, seeing it at $99 when the low is at $85 during COVID. But it doesn't mean I'm gonna go out and buy, okay? Look, it hit 180 and then fell from there. So let's go through our 8 pillars. Pillar number 1, we want the 5-year PE ratio under 22.5. Very simple, main page, 33. Now, keep in mind, that 33 also includes a lot of probably losses or low income because COVID shutdown took a big chunk of their revenue away. And we're going to look at that in the income statement next. Pillar number 2, we want the 5-year return on invested capital greater than 9%. 5-year return on invested capital, 2.4%. Again, this return on invested capital in our software is calculated based on free cash flow. What do you think has happened to free cash flow in the last 5 years, especially with COVID? It has plummeted, and we'll see that later on in the software. Pillar number 3, very simply, I want revenue growth over the last 5 years. So I go to the income statement. I look at 5 years ago, $58 billion. Last year, $81 billion. Now, ironically, guys, I will say this. There wasn't much of a drop in revenue during COVID, probably because their streaming service absolutely skyrocketed. They absolutely killed it. And when you have 100 million people at the time, 2 years ago, streaming something that costs them, that they charge $6 a month for, yet the cost is probably marginal to increase, you're generating $6-7 billion a year in extra revenue at very high margins. Pillar number 4, net income growth over the last 5 years. So we scroll down. 5 years ago was $12 billion. Last year, $3 billion. Guys, look at 10 years. 6, 7.5, 8.3, 9.2, 9, 12, 12.3, loss of $1 billion, gain of $1 billion, gain of $3 billion. So it is still down 75% from pre-COVID, even though they have way more Disney Plus users and all their streaming users, which is a very, very high margin business, okay? So keep that in mind going forward. There's a lot of potential. If they just get back to where they were 4 or 5 years ago, that alone would probably be a pretty good indicator of where they can be. Now, pillar number 5 is something I'm not even looking at yet, but it's important for you to understand. It's a silent killer investing. Shares outstanding. Are they increasing or decreasing their shares outstanding? Now, why is that important? Well, very simply, if the company is issuing shares, they are diluting you as an owner. They're giving you less and less of the cash flow and the revenue and the profit of the business as time goes on. If they're buying back shares, they're giving you more of the business by you just being a very dedicated shareholder. So we want to see shares outstanding staying the same or going down. Now, Disney had COVID. I'm wondering how many shares they might have issued during COVID. A lot of companies did that, airlines, cruise lines, etc. So at the end of 6 years, they had 1.56 billion shares. They now have 1.82. Now, it has been stable, and they did increase the number of shares between 18 and 19. So it was before COVID that they drastically increased their shares. That could have been for several reasons. Could have been, this is a big jump. It might have been for some sort of acquisition. But 10 years ago, they had 1.8 billion. Now they have 1.82. So it looks like it's stabilized. Last few years, it's been stabilized, but it still is more shares outstanding. Pillar number 6 has to do with the debt on a company. Debt on a company works the exact same as it does for you as an individual. The more debt they have, the more likely they are to have bad financial troubles when there's an economic slowdown or something like that happens. So the question is, what's a reasonable amount of debt? Well, based on what I look at, I go back to the metrics page, and I look at the 5-year average free cash flow. Now, guys, again, this is completely skewed because the last 5 years included COVID. Let's go look at free cash flow real quick because I just want to show you before I explain it. Their free cash flow went from $10 billion down to low single digits. It's completely skewed in the last 5 years. So rules are rules. We're going to take this $4 billion in average free cash flow. I'm going to multiply it by 5. I take the 5-year average free cash flow, I multiply it by 5. That's $20 billion. Then I go to the balance sheet, and I want the long-term liabilities of the company to be under $20 billion. We scroll all the way to the bottom. It's $67.5 billion. So this is clearly an X. We've had a lot of X's so far with 2 more pillars to go. Don't be scared, though, because remember, there's a story behind why everything fell so hard. You've got to look at Disney as what's the company when things are stable, not when it is during COVID or during some other time that's completely an outside event. You cannot punish them for that. Just like if a company skyrocketed because of COVID, like Zoom, you shouldn't expect that to go forever, which I did not. Go look at our past videos about Zoom. So the last 2 metrics have to do with free cash flow. So what is free cash flow? It's cash from operations less your capital expenditures. There are 5 things you can do with free cash flow. You can buy back shares, pay down debt, pay dividends, reinvest back in yourself, or make acquisitions. Any one of these 5 you can do in any combination. All 5, 1, 3, 2, does not matter. You can do none of them. The point is, that's what free cash flow is. It is the lifeblood of the business. It's more important to me than earnings. So on our software, on the cash flow statement, I've actually added the line here to make the math easy for you. So free cash flow growth. 5 years ago was 9.85. Last year was 1.2. Big X there. Big drops in free cash flow. Look at the years past. 5.5, 6.2, 6.5, 8.5, 8.5, 9.8. Now remember, when we go in the forward to look at analyst estimates and our stock analyzer tool to decide what price to pay for Disney, we're going to think more about this portion of the company, not this portion. There was clearly a lot going on here that they were reinvesting back in themselves or had some sort of issue with higher expenses for a long-term future. Remember, a lot of companies will run their growth through their operating expenses and not through capital expenditures. For example, hiring a lot of developers. If I'm a company who's going to release some software like a streaming service and I need to hire $1 billion a year with developers, I'm not capitalizing that. That's an operating cost for me. So I'm going to be punished as a company, hopefully for long-term gain, which is hopefully paying off now. So our final metric is we take the 5-year average free cash flow. We want to come up with some sort of value for the company based on a market cap, just like we did with PE. So we take $4 billion and multiply it by 22.5, $90 billion. Okay, we want the market cap of the business under $90 billion. So we go back to the metrics page, we scroll up, it's $181 billion. Again, free cash flow is very low compared to history. If it just becomes the $9 billion it was beforehand, this $90 billion becomes $270, and suddenly you're looking at Disney going, not bad. This might be a buy. So if you're new to this channel, I'm Paul. I'm a value investor. I've been teaching value investing overall for about 10 years and on YouTube for the last 3 years. But just because I have a YouTube channel and just because anybody else has one does not make them an expert. But I guarantee that if you watch 4 or 5 of our videos, you'll walk away understanding more about money and investing, and you'll realize that my process, even if you don't agree with me on everything, is a sound financial process, and you need to subscribe to the channel to learn more about it. So let's go to analyst estimates on the company. EPS. Look at this jump in EPS from $4 a share to $11.40 per share. A big chunk of that's going to have to do with getting rid of all that COVID mess and getting more streamlined, no pun intended, with their streaming services. About 30 analysts here. Revenue growth. This is a lot bigger jump than I expected. We're looking at high single digit, low double digit revenue growth for the next 5 or 6 years. Now, when we use our stock analyzer tool here, it's very, very important that you rewind this as you learn more about this. I want you to rewind this if it gets confusing. This is the most used part of our site. People love this because it allows them to take their assumptions about the future to determine what price to pay today for the stock. We don't know the future on anything we do. Our goal as investors is to make reasonable assumptions about the future and not unreasonable, crazy assumptions. Make reasonable assumptions. It'll show you a price to pay for the stock based on those reasonable assumptions, okay? So let's start here. First off, guys, I'm gonna do a 10-year analysis. And the reason being is Disney's gonna be around for a long time. You can do it between 1 and 20 years, but I just like looking at 10 because it's a couple of recessions, a couple of rebounds, etc. It should be a few market cycles there, and I want to buy the stock over a complete market cycle. So revenue growth. Over a 5-year period, it was high single digits. So I'm going to go a little bit lower for a 10-year period. I'm going to go 7. I'm going to go 4.5, and I'm going to go with 2.5 here. Okay? Profit margin. I'm completely ignoring 1 and 5 years. I'm absolutely going to ignore 1 and 5 years. And with streaming being a higher margin business, I'm actually going to go a little bit aggressive on the high side. I'm actually going to go with 13, 10, 10.5, and 8. I think this low so far is very conservative, but I'm okay with that. And I think this middle part is looking about average, but I look at their profit margin and think, okay, streaming is high margin. Advertising for sports is, I think, only going to get better because of the fact that nobody watches sports. Somebody the other day said to me, like, Paul, did you record the Michigan game? I'm like, no. They're like, oh, you didn't watch it? I'm like, no, if I don't watch it live, I'm not watching it. That's my opinion. And I think a lot of people probably have a very similar opinion. I don't get the point of watching non-live sports. We're in the world of now. I'm going to find out the Michigan score no matter what. If I even open Instagram, it's going to pop up in 3 seconds. So if I'm not watching it live, I'm not watching it. And I think that's the way it is with a lot of sports. So free cash flow. I'm going to mimic free cash flow and my earnings, my profit margin, because they should be similar and the same over long periods of time. Now, PE and price to free cash flow. Guys, this is asking, what's the PE going to be, you think, what's a reasonable PE and price to free cash flow in 10 years? As the company gets larger and larger and larger, it is harder to grow. And growth is a major aspect of PE multiple and price to free cash flow. Same with a high return on invested capital or moat. I believe this moat is huge. As Warren Buffett would say, if I gave you $100 billion today, could you mimic Disney? You absolutely could not. You could not be the competitor to Disney even with $100 billion. That is a very, very strong moat. You should be willing to pay a premium for that. So I'm going to put in one of the most aggressive premiums of all time for me. 14, 16, and 18. I'm actually cringing even writing this because I never want to pay that much money. But I feel like I was very conservative on these other assumptions, so I'm okay putting a little bit of premium on my PE. Now, finally, desired annual return. Guys, you can get 9 or 10% by investing in a long-term ETF. So in order to invest in an individual business with ample margin of safety, you have to get a higher return. If not, just invest in your low-cost ETF and be done with it. Don't do the work. There's no reason to do the work unless you can get a higher return. And as my assumptions get bigger and bigger and bigger, I want a bigger return because I'm making more aggressive assumptions. I want a higher margin of safety. So for a company like Disney, I'm going to do 12, 14, and 16% return. Now, the stock's currently around 100, 99 bucks. I'm going to hit the analyze button. When I do that, 6 numbers are going to pop up. 3 prices based on a multiple of earnings and 3 prices based on a multiple of free cash flow. If the numbers are all green, it doesn't mean go out and buy. It means go do your research. Verify these are correct. So how do you do your research? This is one of the most painstaking parts, but that's why we make it easy using our software. Go out there, go read the pros and cons, the bull and bear arguments for this company. Or very simply, join the Everything Money community. Thousands of people in there All of them researching companies have ideas. I guarantee you Disney's been discussed. You can actually search for Disney, go right to the chat where it's at, and engage in that conversation, see what people have written, and re-engage the conversation. This is the easiest way to do, because research sucks. I don't even like doing research. I try to do as little research as possible because I'm lazy. I get input from people. I have people in there who, hey, Paul, did you see this? I did not see that. These are the important parts of research. So go to everythingmoney.com for less than $1 a day. You can get the software. It gets you everything that you saw already, plus the community. So let's hit the analyze button. Boom. It's close to my number, guys. I added my watch list for $90, so I'm gonna get notified. I have a low price of 43, a high price of 85, a mid price of 60. I have it on my watch list as 90 at a point to do more research. So this video was awesome. It was very thorough. You need to understand margin of safety better. So watch this next video about margin of safety and don't forget to subscribe to the channel. Thank you very much for your time.